Okay, stocks are down across the board here today. Again, not down by very much, and the Dow continuing its losing streak, so that got a lot of publicity today. The question is whether or not we are actually like in an intermediate decline. Are we getting a pullback where it takes, it's more than just a near-term decline, where it takes, multiple weeks to get back up to new highs versus just a few more days. Is that what we're in right now? So I'm going to break down that in today's video, what the charts are looking like, and whether or not I expect that we'll have more weakness coming forth. There is a pretty significant support level right now for a lot of the indexes. I'll show you where and why during the video. There's an opportunity for us to bounce here. I'll tell you whether I think we will or not and why. What might be leaning me in one direction or the other. There's some pretty clear underlying issues that are driving the market right now. Whether they're positive or negative remains to be seen, but there's some pretty clear underlying issues that are driving this action. So we'll break all that down. We'll break it down, how the markets are behaving internationally and what that will tell us. We'll break down how the markets are behaving from a sector rotation standpoint, what that tells us, and whether or not we'll be able to finish this calendar year on a high note, or whether or not we'll end up heading into a new year in the midst of an intermediate pullback that we haven't had for multiple months, really, since the end of August, since the beginning of August there. So we'll break down all that in today's video. Our trade idea is in the consumer discretionary space, which has been on fire. This stock has not been on fire. So we'll break it down and its breakout pattern that it actually has today, and we'll talk about how to trade that. So let's go ahead and get started. Today is Tuesday, December 17th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos where I take a look at old Market Outlook trades I've done, see whether we should stay in them or get out of them. We got out of a few yesterday during that class. We also put on today's trade idea before the market closes. We always do this at 3:30 Eastern time, and you just click on this image here to get to it. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. Scroll down and click this like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day after day. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 like we always do, and take with the market forecast indicators. You can see we are now less than a percentage point above the 30-day moving average as we fell today. The intermediate line, however, is still rising and is still above the 90th percentile, much less above the 80th. So we are still clearly bullish. Market sentiment's falling, but also still above the 80th percentile. The intermediate line is still above it. So I mean, we're not on the cusp of an intermediate decline, at least as of right now on the S&P. We did talk about this bullish near-term peak, the probabilities that we would not get the near-term line up above the 80th percentile, and we did not, as the momentum line fell back down today. We did finish off the lows, and that kept the momentum line out of oversold levels, and the near-term line is actually down, so that helped keep it higher, but still not bullish, right? The second day we need to be above 80 on the near-term line if we're really going to be bullish and really get a good near-term decline or rally going like it was here, and that's not the case right now. The momentum line's too weak for that. So it appears that we're still moving lower. You can see the Dow Jones, which has now fallen for the 9th day in a row, the first time since 1978 that's happened. First time that we've been this close to all-time highs, within like 5%, I believe, of all-time highs, and above the 200-day moving average for that to happen. So it's been a while. This is a historic move that we've had, 9 days decline. If you look at the equal weighted index, because there's a lot of chatter today about the Dow being not a good index because it's price weighted. But the S&P 500 equal weighted has been down 12 out of the last 14 days. So it's not just the Dow, right? And you can see its intermediate line is actually below the 50th percentile there. So the Dow gets a lot of blame for being stupid, right? Because it pretty much is stupid. But that's not the reason why. That's not the reason for its bearishness. The reason for its bearishness is we got a broad decline going on right now. And the only thing really keeping it going is keeping the S&P from looking worse than it is literally the Mag 9, right? If we were to extend it out to Broadcom and Netflix, you can see 8 of the 9 are pretty bullish, right? And pretty darn bullish, like really bullish, with only Nvidia out of those 9 being in an intermediate decline. So you could, you could argue that it's actually the S&P 500 right now that is the index that's broken. And I'll show you later a precedent. We've seen this before where the S&P has been flat, but the Dow Jones has dropped. We've seen this before. You might know where I'm going with when we have seen this before, because I've shown you a lot of analogs of the current market environment to that particular market environment. But I'll show you that later here in the video. Let's take a look at the Russell 2000, which is looking pretty similar to the Dow Jones, which again goes to show that it might not be the price-weighted average that's hurting things, as the Russell 2000 has also been on a decline for the past 9 days. There's been a few up days in the midst of that, but not very big up days, and we're still down. The intermediate line's almost below the 60th percentile, so it's almost out of bullish territory. Short-term sentiment was looking better yesterday, did not really get out of bearish territory today. And you can see that we're still below the moving average by almost 2%, and the line is yellow. So that's kind of what's going on there. If you take a look, let's see here, at the two-line versions of this chart, let's take a look at, no, excuse me, I'm sorry, let's go back to the NASDAQ 100, because I wanted to show you the NASDAQ 100 first. So the NASDAQ 100, the market forecast chart from the NASDAQ 100 is still pretty bullish, right? The intermediate line, I mean, we almost got a cluster yesterday, as we talked about. The near-term line did fall today because we fell down 0.5%. But the near-term line is still pretty bullish, still above the 80th percentile. So it's not quite a bullish near-term peak, but it's clearly a higher high point, even if we are setting ourselves up for a near-term divergence for a lower high point on the near-term line. It's clearly a higher high on the index itself. The intermediate line strongly bullish, the market sentiment line also above the 80th percentile. Okay, now let's take a look at the weekly chart for the S&P 500. We talked about the lower high point we had last week leading to a potential transition this week. We do have a upper and lower shadow. We do have a lower close now. So it's not quite your typical transition week, especially not a bearish one, but you can see how we're definitely weakening here as the size of the candle is really getting small. Your Dow Jones Industrial Average is on a bearish candle and a red arrow now. This is the first time we've got the red arrow for a few months. As the PPO is falling, a pretty decent sized bearish candle as well. Your Russell 2000 also shows a bearish candle, does not have the after transition and a lower high. It does not have the red arrow yet, but the PPO is falling. And then finally your NASDAQ, it's just its own animal, right? Because those Mag 7 company, Mag 9 companies, really decent sized candle, still above its moving average. So still pretty strongly bullish there. Let's take a look at the 3 green arrow charts. We obviously have 3 red arrows for multiple days now on both the Russell 2000 and the Dow Jones Industrial Average. S&P, however, has only 2 red arrows. The NASDAQ has 3 greens, so it's clearly doing its own thing while everything else is showing different stages of weakness. If you look at the 2-line version of the chart, sorry about that, let's look at the 2-line version of the chart here. You can see we are close to the 17-day moving average. MACD is moving below. So we are in convergence mode at best, right? The MACD is below its moving average, hence the red arrow on the histogram. The stochastics is also below its moving average and out of the upper reversal zone, and but we're still above the 17-day. Obviously not the case for the diamonds, as we are close to flirting with the 50-day average now, and flirting with an official pullback. IWM the same, right? IWM is also flirting with its 50-day now. So if we're going to end this, this period without getting a pullback, this is where it's going to end, right? If it's not going to end at the 30, it's got to end here because there's a pretty sizable gap between the 50 and the 200. We don't really want to get below the 50. So we have an opportunity for the Dow and the IWM to break this losing streak here. At a relative, at a pretty significant area of support. A lot of people look at the 50-day moving average and an opportunity to bounce off of it. Let's take a look at some of these other oscillators. For the DMI, you can see we're still okay on the S&P. Not as strongly bullish as we were, almost below 25, but still above 25. And we are above 20 now in the negative indicator, so the ADX is falling, and we don't have that bullish trend going on anymore. You look at the RSI and the CCI, we're not above 60 anymore in the RSI. We're not above 0 anymore in the CCI, but we're not at bearish levels either. We're not even below 50 yet on the RSI, so we're still okay there. Looking at the Ichimoku cloud, we're still above the cloud. We're still above the blue line. We still have an intermediate strength trend. Right, when we lose that is when we have to worry. So we lost that on the diamonds a couple of days ago, and that's when you start to worry about a new trend. We've gone negative on the rate of change on the diamonds, but at least we're still above the cloud. We're clearly above the cloud, and we still have a positive rate of change on the S&P. So we're still okay, right? We're not breaking down into a bearish trend yet. We're still in the we're not in the upper quartile anymore, but at least we're still in the upper half of a declining bandwidth. We're still below the Keltner channels. The momentum is positive. It's pretty still strongly positive. The diamonds is a different story. The diamonds, we are in the lowest quartile now. The bandwidth is pretty high. We're flirting with the lower Keltner channel, pushing against it, and the bandwidth has just barely turned negative. So we'll see if that turns into more negativity without the red dots, right? Because we're still got a pretty high bandwidth, and we never really produced the squeeze pattern where the bands move inside the Keltner channels in between trends. So there's a potential for there to be more volatility on the diamonds because of this. But like I said before, if we're going to stop it and bounce, this is the point where we're going to do that. I don't think that we will. I think that we're heading into more weakness, as I'll show you here in just a second, with the breadth indicators. They're very, very poor. They look very bad. So I don't think we'll stop here, but you can see over the next couple of days that there's an opportunity for it to. If it's going to, there's some support here. I just lean in the latter direction. I lean in the direction of it continuing the weakness and spreading into more than just the Dow Jones Industrial Average. If you take a look at the intraday chart, we did get a lower high and a lower low, and we closed below yesterday's low. We did gap down. It's a common gap, so again, there's a chance that we can fill that in. Pretty good chance that we would fill it in. We don't have a new high, so we're clearly below 70. We're setting ourselves up for a bearish crossover and a significant drop in the size of the 4-week range. The diamonds, we are actually clearly in the lower half of the range. In fact, now we are clearly in bearish territory. When you look at it from this perspective, we are clearly in bearish territory here, well below 40, almost in the reversal zone. The Russell 2000 had bounced back up above 40 yesterday, but dropped back below it today. So we are in bearish levels on both the Dow and the Russell 2000 here. So it's not just a price-weighted index that's hurting. It's more broad than just that. We don't have the Arun patterns yet on the Dow or the Russell 2000 because we don't have the new 4-week low point yet, but you can see, so here's today, here's tomorrow. So tomorrow is Wednesday, this is Thursday. This is where the low point is going to be Thursday, and then this will be the 4-week low point. If we don't get a new one in the next 2 days, this one will be the low point on Friday. So we're going to get a jump in the negative line, and if not tomorrow, the next day, for sure on Friday. Then the question will be whether it actually gets up to 100 or not. And we see the same thing as well in the Russell 2000 because, this is today, this is tomorrow, this is Thursday's low point. If we don't get a new one tomorrow or Thursday, this will be the low point on Thursday. So we are set up for the breakup with the bearish pattern, the bearish breakout patterns by the end of the week on these two indexes. If you take a look at the volumes, I showed you the range and the volumes are below average. If you look at them on this chart, the ATR is extremely low, down to 0.71.5. You look at the volume is extremely low. That continues to be the case. The volatility, however, remember how it was up yesterday? The market was up and the volatility index was up. Well, now it's up again today, and it's back up above 15 and back above the 85% mark relative to the VIX 3M. And your VVIX is up above 100. So things are looking a lot different here on the VIX. Even with the S&P not falling yet, the VIX is rebounding in a pretty significant way above its 30-day average and almost above the 200-day. So it looks like, you know, that the market is anticipating more weakness. We saw the weakness set up on the skew, right? The extreme levels on the skew. Well, the skew remains at extreme level. The average is at 163. Today's skew here was at 166. That needs to be updated actually today. But still is at very, very high levels. And you can see the long. So as this drops, usually that's not necessarily the best thing for the markets to see the skew dropping. Especially from, I mean, it's one thing for it to drop when you're already pretty low. It's another thing for it to drop when you're extremely high. That usually coincides with weakness and volatility in the VIX. Because again, the VIX drops after the skew drops. All right, let's talk about what's driving the price action here today. You can see over the 3 months, the Qs. I mean, that's the big driver everybody's been talking about, right? And we'll talk about it a little bit more here in just a minute. But if you take a look at just today alone, whoops, that's not what I wanted to do. There we go. Bonds are up today. Gold, the dollar's up. High yields outperforming. Gold is outperforming. So this is a clear risk-off day, especially in the international markets, where the developed markets are down 1.5%, emerging markets down 2%. I mean, in fact, if you look at kind of what's the major global marketplace here, obviously your S&P has got dark green shading and green line, pretty much only in the Dow and the S&P. Everything else is not looking so hot, right? In fact, look at the big drops after gaining. At the end of November, beginning of December, in a lot of these developed markets, they've really come back down. Italy dropping today, UK dropping big today, Japan dropping big today, Korea, Canada dropping big today. These are all big drops and big moves to the downside. I mean, they're dark pink shading in a red line for quite a while for France, and all these countries have had dark pink red lines for most of the past 3 months. If you take a look at their charts themselves, here's EFA. We are below the 200-day moving average, so that means we are in correction level. So, and I hear, like Scott Wapner will say, NVIDIA technically has entered correction levels. No, because it's exceeded the 10% declines. Like, no, that's not how it works, right? It's got to get below the 200-day moving average. Any move from between the 50 to the 200, any move down to the 50 is essentially just a near-term decline. You break the 50, now you're looking at more of an intermediate decline, and all the way down to the 200. So a pullback all the way down to the 200-day. Those only don't take very long. You're back up to new highs within weeks. If you get below the 200-day, now it takes a lot longer to get back up. So more like months. So that's why it's correction. You're in correction mode, and you are in correction mode on the on EFA. So you're below the 50-week, and you're working your way down to the 200-week. That's what a correction looks like. That's where we are in EFA, and we're actually below. We were trying to get above the 200-week, with China a few months ago, but we're back below the 200. Remember, getting below the 200 and staying below, it's a bear market for a stock, and so things have not looked so good for EEM. They were looking better for EEM until like today, right? We were above the 200-day, things were looking okay, but we've been below the 50 for a while. We've been in pullback mode for a while, tried to overcome it. This may very well be a failable pullback bounce, and then now we're in correction, because that's what corrections are: pullbacks and then failed pullback bounces, and then we break the 200-day and then some. You can see the MACD is turning negative, stochastics turning negative. We're below the point of control. So it looks like we are starting a correction on EEM, just like we've been in correction for developed markets, right? So there's your pullback, fail pullback bounce. Probably this one would be your fail pullback bounce, because we've been a little bit below that 200-day, and this would be your failed pullback bounce here. And then now, the correction by being below the 200-day and working your way down. MACD and stochastics clearly lower. So now we're in correction mode. And you're seeing this, right, and the other indexes like the diamonds. A lot of chatter today about the diamonds. It's down 9 days in a row. It's a poorly constructed index. The diamonds, and that it's right now, I think it's actually the S&P 500 that is the poorly constructed index. The Dow Jones Industrial Average is a price-weighted index. These three biggest companies are UNH, Goldman Sachs, and Microsoft. Those three companies make up about 21% of the Dow. 3 out of 30. So 10% of the Dow makes up 21% of the Dow. But the top three companies in the S&P are Microsoft, Apple, and NVIDIA. those three companies make up almost 21% of the S&P. So 3 out of the 500, or 0.6% of the S&P 500, make up about 21% of the S&P 500. So it's actually the S&P that's actually a lot more poorly constructed than the Dow Jones Industrial Averages. In fact, if you look at the Dow Jones here, it's typically very correlated with the S&P 500, generally speaking. It hasn't been lately. It hasn't been a few times this year, and there's been another year where that's been the case. 2021 was also another year where there were multiple periods, including in November. In fact, if you look at the end of November, check this out. Right, we had about a 9-day period, or 11-day. We had a 9-day loss, right? But it was out of 11 days, 9 out of 11 instead of 9 out of 9, like we get right now. The S&P 500 was positive. The correlation went negative, briefly negative. We've seen that here, where it went briefly negative. And then you can see we rebounded there in November. So it'd be right. Where is it? This actually I went past. No, it's right there. So we rebounded eventually, right? We actually went lower. We had our intermediate decline, and we rebounded. But that was kind of a signal that things were not looking good. Again, we had multiple instances of that in 2021, multiple periods where the correlation had dipped below this 25% mark. Whereas in 2022 and 2023 combined, it never dipped below 25%. The positive correlation. So typically, the Dow is very positively correlated with the S&P. When it's not generally the Dow that's wrong. It's generally the S&P that's wrong. If you look at the Dow's correlation with RSP instead of, so this is the equal weighted S&P 500, then you can see it's generally very positively correlated. I mean, there's, again, brief periods of time where it's not. And again, this is only over 2 weeks. But for the most part, it is very positively correlated with the Dow Jones. And you can see the charts look pretty much the same. Again, until like recently, there was a less of a positive correlation, but still positive nonetheless. And so, again, it makes it so this is the S&P. It's just equal weighted S&P versus the price weighted Dow Jones. So it appears it's probably the S&P that's the poorly constructed index when 20% of it can be from one particular company. In fact, if you go further out here past the one company, and you look at the, now it's kind of like a Mag 9, right? We've included Netflix from the FANG days, but it's still up there. And then you also include Broadcom now, which has definitely worked its way up in the past few days up into the list. But if you look at these 9 companies combined, 7.41, 6.51, 6.3. So there's the top 3 making up over 20%. Then you add on Amazon, and you add on Meta, and you add on Tesla. Now you add on Broadcom, you add on Google, right? Both share classes of Google. And then you add on Netflix, which is down at the bottom. So that's 36% from 9 companies, making up more than a third of the index. 9 out of 500 is 1.8. Right, 1.8% of the index makes up over 35% of the index. That's a poorly constructed average. If you ask me, that's the one that's wrong, and traditionally has been the one that's wrong. So a lot of chatter today about how the Dow is, is the one that's down and it's pushing us lower. But it's, if you look at the breadth, it's not just like a price weighted average. The breadth is horrible. Like we are almost below the levels we had during this decline. Like we're down to minus 79. This is the lowest level the oscillator has been since we were actually in an intermediate decline in the spring. Very, very big, sharp drop to the downside on the oscillator. If you look at the money flow, right, the money flow has been, as I've shown you before, on a pretty steady decline. That's not what I wanted to show you. I wanted to show you over here. The number of stocks above the 200-day moving average, right? The number of stocks above their 200-day moving average. This has been so high. Look at that sharp drop, way below the moving average. And we're still less than 1% below. Like if you look at the zigzag chart here, from the all-time closing high, we're only 0.88% away. And yet, if you look at the 200-day number of stocks above their 200-day, we're at the 52-week lows. we're lower now than we were at the bottom of August the 5th. August the 5th, there were 314 stocks. We're at 312 right now. August the 7th, there were 313 stocks. We're at 312 right now. And we're still, I mean, and back then, on that time frame, we were 8.5% below the all-time closing high. And now we're, 10 times less than that. So the breadth is just very, very pathetically low here. When you look at the new highs and new lows, so we jumped up yesterday, we jumped up above that 4% mark. Generally speaking, when you jump up above 4%, that's usually a sign you either are starting a more extended decline or you're ending an intermediate pullback. Well, we haven't even started an intermediate pullback, much less end one. So we can't say we're doing that. But take a look at this. Again, we'll take a look compared to 2021. So let's look at the calendar year of 2021. That same November timeframe that I showed you before. So we'll go January 1st of 2021 to December 31st of January 2021. So you remember that November timeframe where we had the 9 days at 11 to the downside? Well, if you take a look here on that same time frame on about November 22nd, we also jumped above that 4% mark on new lows. Again, we were not in an intermediate decline yet. The Dow was starting one. The Dow was down 9 out of 11 days. But the S&P was still pretty flat, was barely below its all-time highs. And you can see the new lows jumped up above a key level. Again, and eventually that started the move, what eventually became the correction low point, right? The correction move. Because the breadth was so bad at the end of 2021 and the CAPE ratio was so high. So we need to go 2022. I wanted to show, there we go. So you can see there's that period. In context, back on the 2021 chart, it looked really bad. When you look at it in 2022, not so bad, right? Because we had some big peaks on the new lows when we were at these big time drops. But you can see how it started a lot of volatility into a period of a lot of volatility when it was still close to new highs. Very similar. I mean, almost the exact carbon copy picture of what we're seeing right now. It's just happening in December instead of in November, like we saw 3 years ago. So, like I said, you can see a big move lower, and you can also see it as well showing up in the sector moves. When you look at the sector rotation here, let's take a look at the sector rotation here. Again, you can see it. Tesla is just killing it, and so is XLC. But if I look at just today alone, you can also see how things are playing out. Right, XLY is still the outperformer. XLP is actually up. All the safety trades are there. But energy, industrials, financials, right? The sectors that were supposed to be leading this broadening trade are really struggling. And even XLK, which is our big leader, which has NVIDIA in it, that's the one that we need to lead the way higher. It's underperforming. So things are starting to, and if I were to go back over this 9 days, 1, 2, 3, 4, 5, 6, 7, 8, 9. This is that 9-day period where the Dow has been struggling, right? The S&P is down 0.8%. You only have two sectors outpacing it. XLK is kind of matching it, but it's down as well. But look at everything else, right? As the broader area of the markets are really struggling right now. And we saw that in 2021 and eventually led to an intermediate pullback and a failed bounce and ultimately a correction. And I don't know if we'll go to a correction now, but it does appear that this is leading us into a year-end intermediate decline. If not by the end of the year, if we're not ending the decline by the end of the year, we're probably going to be at least starting it by the end of the year going into next year. All right, now that takes us to our trade idea of the day. It's actually in the discretionary space, the consumer discretionary space. As a home builder, Lowe's really breaking down, getting a bearish intermediate peak. The intermediate line got into bullish territory, got above market sentiment, but peaked without getting in the reversal zones. That's pretty bearish. Obviously, then crossing below. Now we're in intermediate decline again, but you can see we're closing below these prior lows that we've had, these prior attempts at an intermediate low point. So a pullback, failed pullback bounce, and now we're starting to work our way down. You can see short-term sentiment's pretty bearish down there. You can also see the weekly chart is looking pretty negative as well as We had a big transition candle last week with the red arrow, and then a big bearish candle now this week. The PPO is falling. We are clearly below that 10-week moving average. You can also see we had 3 red arrows. On the day of the 3 red arrows, we had a pretty decent bump in volume, above average volume, and we've been working our way lower ever since. You can see we are moving between the 50 to the 200-day moving average. There's some pretty strong support at the top of the value area, the 200-day moving average, a big volume node. So all around 245-ish, plus or minus. Right, so there's a move there, but there's a gap down to that point, as you can see, that as we fill in the gap between the 50 and the 200 there. The 8 and 17-day have both crossed below the 30-day moving average. If you take a look at some of these other oscillators, you'll notice, we're almost above 30 on the negative indicator. We're below 20 on the positive, so your ADX is just starting to rise. When you look at the RSI and the CCI, they're showing bearish patterns, below 40 on the RSI, below 100, well below 150 on the the CCI. In fact, the weekly CCI barely crossed below 100 here this week. So just starting a bearish trend there from that perspective. The Ichimoku cloud, you can see, has just crossed today to weak bearish levels above 50 and below -1. Below the cloud, negative rate of change for the first, the last 2 days has been a negative rate of change. And then finally pushing against the lower Bollinger Band, pushing against right here, pushing against the lower, but not down below it, but pushing down against it, pushing against the lower Keltner channel. The bands crossing outside of the Keltner channels for the first day today. With that green dot there, the momentum is just starting to turn negative. So it looks like we're just getting going here. But like I said, we have some, we don't have like 240 is actually below that really significant support level. So instead of selling the 240, we already put this trade on the Market Outlook Live video. We'll sell the 250 and we'll buy the 260. Right, that gives me this trade about a, 1.5 to 1 reward to risk ratio. $400 at risk, $600 reward. A lot of flexibility for timing. As long as the max gain is still inside of 1 standard deviation, we're still okay. So I like the setup, and that's our trade for today. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.